Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. This is a discussion of monetary trends around the world. It's been given at the end of May 2020. The coronavirus pandemic is still very much with us, although hopes are that the lockdown is coming to an end. And these medical developments dominate the economic situation. Today I'll be talking very much about the United States, as I have been doing in the last 2 or 3 sessions, because in the United States there is at the moment an extraordinary explosion of money growth of a kind that I haven't seen in my career, which now goes back over 40 years. Let me just say at the start that this presentation will be somewhat controversial. I'm going to be talking about asset prices and also particularly about the equity market, the stock market. And I have to just put in a disclaimer here that the Institute is a charity. It's attached to a university. This is not an investment advice. However, asset prices are important to the economy, and the economy is important to inflation and unemployment, and the discussion of inflation and unemployment is a very important part of what the Institute does. The last few months, of course, has been a very difficult period, and the Federal Reserve in America, America's central bank, is worried that asset prices may fall from here. It's putting out warnings that it thinks called real estate prices of commercial property may go down, which of course will affect the banks because most bank loans are secured against property, against real estate. And these kind of worries about asset prices are not confined to the Federal Reserve. In fact, there are very successful equity investors who believe that at the moment the American stock market is too high, rather frothy in their view, particularly in view of this shocking effects of the pandemic on output and employment. And so many of the most distinguished and successful long-term investors in equity markets at the moment are giving out warnings that the market should fall. Now, I too am worried about asset prices, so in this sense I share an interest in this subject with the Federal Reserve and some of these very distinguished investors. However, my worries are very different. My worries are in fact that we may be, in fact in some sense are, in the middle of an asset price bubble, which has got further to go. And I'm going to base this argument on the behavior of money. Let's just think about an individual fund manager. Fund managers obviously receive cash to invest. They've got some money that in their portfolios that they must invest. They mustn't keep too much money around because it's their job to invest the money. It's a bank keeps cash as such for its depositors. Its fund managers invest the money. So they have a low ratio typically of cash to total funds under management. And we can obviously represent this algebraically so that their assets under management are equal to the amount of money they hold divided by the proportion of money to assets. And this same idea can be extended to the entire fund management industry. Potentially there must be some average concept of the ratio of money to assets held by the fund management industry, and the total value of the assets run is going to be equal to the money held by the fund management sector divided by that average proportion. Now I'm now going to make a bit of a leap in order to simplify the discussion. Let's take it, for the sake of argument, that the only holders of equities in an economy are those running fund management funds held in the fund management sector. Okay, that the specialist fund management sector is the only investor in equities. Let's also assume that equities are the only asset that these fund managers run. I'm just doing this to illustrate the general argument. Then it must be the case that the total value of equities in the economy is equal to the money held by the fund management sector divided by the proportion of money to the equity portfolios being run in the fund management sector. It then follows, this is all just logic, it's all very straightforward, that the change in equity prices is equal to the change in the quantity of money held by the fund management sector to run in equity portfolios minus the change in the proportion of money to assets, equities under being managed by the specialist fund management sector. The first of these, the change in the amount of money held by the fund management sector, is obviously a result of wider monetary trends, monetary policy decisions. And since money held by the fund management sector is only part of all money in the economy, it's going to depend in part on the rate of growth of money as a whole in the economy, and partly it's going to depend upon the extent to which people put their assets into the fund management sector, they allocate their wealth towards the fund management industry. Money held, of course, by, in America, mutual funds, insurance companies, pension funds, and so on. And then it's going to depend, this change in equity prices, on the change in that proportion of money to assets under management. And that will depend on what investors, what the finance industry, how they feel about the future. If they're pessimistic, if they're bearish, they will have a higher ratio of cash to assets than normal. And if they're very bullish, they will have a lower ratio than normal. So this ratio will change, and that too will affect asset prices. So what we've got here is a framework for thinking about movements in the stock market, focusing very much on the United States, but the framework is generally applicable. Now, this then, in terms of understanding what's going on at the moment, makes us want to look at the data for the growth of money held by the financial sector, and then also to make take a view whether the markets are bearish or bullish or whatever. Now, this is a somewhat complicated topic, and what I'm going to do is I'm using some numbers that the Federal Reserve puts together. I would just say before I come on to the American data that as an analyst in Britain, I used to follow these aspects of the investment scene on a regular basis from month to month. And in 2005, I published a study called Money and Asset Prices in Boom and Bust. And I showed that over the 30 years just before, from 1973 to 2003, when I've been active in the City of London, that the ratio of money held by the fund management sector to total assets had increased in that 30-year period by about 50 times, but the ratio between the money held and total assets hadn't varied much. At the start, I think it was a bit over 4%. At the end, it was just a touch beneath 4%. But over that 30-year period, when the totals of assets and fund under management have risen 50 times, the ratio hadn't changed. Now, true enough, there had been periods when that ratio had been very low, when markets were very bullish, that middle of 1987, and other periods when the market's very bearish, like 1974, when the ratio had been up at 9%. But in the long run, the driver of the increase in the value of the assets run by the fund management industry had been increase in the quantity of money held by the fund management sector. And in my 2005 study, I illustrated this by just a very simple arithmetical example on pages 37 to 39 of that study. Suppose that the average ratio of money to assets is 4%, 0.04. Suppose that the money held by the fund management sector is £40 billion. Then the value of the equity market will be £1,000 billion, very simply. If the money held by the fund management sector suddenly jumps, whatever reason, to £60 billion, fund managers have got too much cash. They all have got too much cash relative to long-run behavior. They're all buyers. They need to buy and sell between themselves, in the example I'm thinking about, with the rather stylized assumptions I've made, but they all want to get their cash ratios down because they've all got too much cash. So they're all trying to buy stocks at higher prices. Equilibrium is restored. They're all keen to buy. They buy and sell at higher prices until the stock market rises, the value of the equity market rises to £1,500 billion, and then with the £60 billion, the 4% ratio is restored. Okay, so this explains how equity markets valuations are determined. It's a very simple theory. I've used it in my career. It admits that the changes in bullishness and bearishness in the markets, short run, can be quite large, very problematic to forecast. Nevertheless, in the medium and long run, what really matters is the quantity of money held in the fund management sector. So let's look at now the American data, and I'm going to use some numbers prepared by the Federal Reserve in a series that goes back, a large number of set of data series that go back to the 1950s, early 1950s, on the American flow of funds. This shows that at the end of 2018, I'm looking at what's happened in the last 18 months or so, okay? End of 2018, the amount of money in the American economy held by all of the households, companies, financial institutions was about a bit over $17 trillion, $17,000 billion, a bit less than GDP, but not far off. And this was split between households, which are by far the most important holder of money balances, and then, if you'll just forgive me, the financial sector held about $1,200 billion, $1.2 trillion, and company sector, non-financial corporates, held a bit over $3 trillion, $3,000 billion. I'm not entirely sure about these figures because I think they exclude some money market funds held by financial institutions, and in a separate series, the Federal Reserve quantified these at the end of 2018 as being over, heading on for $1.9 trillion. This complication doesn't in fact change the conclusion I'm about to draw. We can then compare the figures at the end of 2018 with the figures for the end of 2019, which have already been published. There was an acceleration in money growth in the USA in 2019, even before what's happened in 2020. Money growth moved up to a bit over 8% at the end of the year, whereas much of the previous years it had been about 4%. And in fact, what happened was that the household sector increased its money balances in 2018 and 2019 by 5.5%, the financial sector by 22% more or less, and the corporate sector by about 15%. Now, I said there's some ambiguity about the money held in the financial sector, so let's just look at what was held in these institutional money market funds in a separate series. They jumped by 21%, about the same figure. In other words, I've argued that equity markets are determined at the level by what's happening to money balances, an important influence, and that in the USA in 2019, they jumped in 2019 by about 22%, 22%. It's part of the reason why at the end of the year, the stock market was doing pretty well. Before, hardly, maybe there's one or two clouds on the sky, but not the really dark, menacing cloud of the coronavirus. Now, just one more ingredient to the analytical recipe I want to throw in here, which is that in my work over these decades, the last 30, 40 years, I've found that financial sector money is much more volatile than money held by households and companies. It's much more, fluctuates a great deal more. And we saw this in the Great Recession, but I could give many other examples of this general point. So 20% jump in money held by the financial institutions, fund management sector in 2019. What about 2020? Well, we know that since the end of February, there's been the most incredible surge in money growth. Roughly speaking, the increase in money balances held by the whole economy was about 4% in March, about 7.5% in April, probably going to be about 3 or 4% in May. A jump in the quantity of money of about 15%, perhaps a bit more, in a mere 3-month period. We know the financial sector is more volatile than the whole economy. I put it to you that there, the money balances rose by 25-30%, which fits, because when the Federal Reserve buys assets, it buys assets in the first instance from the financial sector, from the pension funds, insurance companies, mutual funds, and so on. So, we had a 20% rise last year, a little bit more than that. We've had 25-30% rise on top of that in the first 5 months of 2020. Conclusion, the money balances held by the financial sector in the USA are up by about 50% on the level at the end of 2018. Now, people at the moment are pessimistic. We've got all these commentators, the Federal Reserve itself, worried about the stock market being frothy. And indeed, the American stock market is around where it was a year ago, despite all this dreadful news. Investors are holding more cash than normal. Their money balance dropped by 50%, stock market hasn't changed. They are bearish. But what happens if they return to normal? What happens to the stock market if, instead of having more cash than usual, they said the cloud's going away and suddenly the sky is sunny again and they want to get into the market? Of course, the market will go up. So I'm worried about asset prices in the USA, but in a very different sense from the Federal Reserve. I'm worried that asset prices may surge further, and then this will be part of the reason why the surge in money growth then affects the economy more generally. And it's part of the reason for expecting that in 2021 we will see not continued recession in America, but an inflationary boom. There's a lot more to say. This is a fascinating time. I would just finish by commenting that the Federal Reserve, the economists there and so on, are much more worried about recession and deflation than about boom and inflation. And this too is a reason for expecting 2021 to be a very buoyant year for the US economy. Because the bias in policy is still towards ease. We've had this incredible 3-month period of a 15% surge in the quantity of money. That may be behind us now, but my surmise is that we're still going to see money growth in the next few months up to the presidential election of, say, 1.5% a month, and so we'll continue to get this rather sort of strange situation where there's so much pessimism, so much worries, perhaps easing a little bit, and a lot of money being created in a quite astonishing way. Thank you.